Most traders never figure out what actually kills them. They blame the market. They blame bad luck. They blame the broker, the timing, the economic news, the fact that a central bank somewhere made an announcement at the wrong moment. They buy more courses, download more indicators, watch more analysis videos, and then lose again, in a slightly different way, for exactly the same reason. And the reason is not their strategy. I have known traders with brilliant strategies who destroyed themselves. I have known traders with flawed strategies who survived and prospered. The difference was never in the system they followed. It was in how they followed it. Or more precisely, in the moments when they stopped following it entirely. Consistency is the most brutally underrated skill in this entire profession. Not intelligence, not pattern recognition, not the ability to read a chart. Consistency. The ability to behave the same way on Tuesday when you are down 3 trades in a row as you behaved on Monday when everything was going right. That is what this is about. I want to start with something that cost me a fortune before I finally understood it. The market does not punish ignorance. It punishes behavior. I have watched men who knew everything about the mechanics of speculation destroy themselves through a single pattern of behavior they refused to correct. I was one of them, more than once. I understood the theory. I could analyze a stock, read the tape, identify the moment of accumulation, see the pivot point forming, and then I would watch myself do exactly the wrong thing anyway, not because I did not know better, but because in that specific moment, with real money on the line and the tape moving against me, something else took over. Fear, greed, or the particular arrogance of a man who had been right many times and had begun to confuse a streak of good judgment with infallibility. The market corrected that confusion without mercy. What most traders call a strategy problem is almost always a behavior problem wearing a strategy disguise. You convince yourself you need a better entry signal, a different time frame, a refined set of indicators. You spend 3 months building a new system and then deploy it, and within 2 weeks, you have broken every rule in it at least once. The system did not fail. You did. Not because you are weak or undisciplined in other areas of your life. Most traders I have known were disciplined in remarkable ways, dedicated professionals, responsible people, often highly successful in their careers. But in the market, something different happens. The emotional stakes are different. The feedback loop is instant and punishing in a way that almost nothing else in professional life is. And so behaviors that you would never exhibit in a boardroom or a negotiation emerge, sometimes within seconds of entering a position. Here is what I mean when I say the market tests behavior. It does not test it occasionally. It tests it constantly. And it tests it most severely precisely when you are most vulnerable. When you have just taken a loss, and your instinct is to recover it immediately. When you have had a series of wins and your confidence has quietly crossed the line from earned certainty into dangerous overconfidence. When the price is moving fast, and every second you wait feels like money slipping away. These are the moments that define your trading. Not the textbook setups, not the clean, orderly, perfectly formatted trades that exist in backtests and journals. The messy, ambiguous, high-pressure moments when the voice that tells you to break your rules sounds completely reasonable. That voice is your most dangerous opponent, and it lives inside your own mind. Let me tell you about something I observed early in my career that I have never forgotten. There was a trader I knew, a man of considerable analytical ability, who had developed a genuinely effective approach to reading the railroad stocks of the day. He could identify the fingerprints of distribution with an accuracy that few others matched. But he had one habit that neutralized every edge he possessed. After a winning trade, he would immediately look for the next one. He could not sit still. The profit was in his account. The trade was over. And before the tape had even fully confirmed the move was done, he was already scanning for his next entry. He was not greedy in the conventional sense. He was addicted to being active. Sitting still felt like losing, even when sitting still was exactly what his own analysis told him to do. Over 3 years, he gave back nearly everything he made through this single behavioral pattern, not because his analysis was wrong, because he could not wait. Patience is not passive. This is one of the most important and most consistently misunderstood aspects of professional speculation. Waiting is the trade. When I say I made my money by sitting, I am not describing inactivity. I am describing one of the hardest forms of discipline that exists in this profession. The discipline of remaining completely still when every instinct you have is screaming at you to do something. The amateur trader equates action with progress. He feels productive when he is trading, purposeful, engaged. The professional understands that most of the time, doing nothing is the highest value activity available to him. The right trade, at the right moment, in the right conditions, is worth 10 trades taken out of restlessness, or boredom, or the vague anxiety of watching the market move without you. This brings me to the concept I want to spend real time on, because it is where almost everything goes wrong for traders who otherwise have everything they need to succeed. The problem is not that traders do not know their rules. The problem is that they know their rules and break them anyway, and they break them specifically in the moments when following them is hardest. It is easy to follow a rule when the market is cooperating, when your position is going in your direction, when nothing feels threatening, when confidence is high. The rules feel natural and obvious. The test comes when the market moves against you, when the loss is growing, when a voice inside you says that this particular situation is different, that the rules applied last time, but this time, the circumstances are unique enough to justify an exception. There are never exceptions. Every exception you grant yourself is a brick removed from the foundation you are trying to build. Because the moment you discover that you can break a rule when the pressure is high enough, you have taught yourself that rules are optional. And optional rules are not rules. They are suggestions. And suggestions will not keep you solvent in a market that has no interest in your comfort or your rationalizations. So what actually builds consistency? Not motivation, not inspiration, not a better mindset or a more sophisticated understanding of market theory. Habits built through repeated correct action under pressure. This is the only mechanism that works. Your brain does not learn from what you intend to do. It learns from what you actually do, repetitively, over time. Every time you follow your rules in a moment when it would have been easier not to, you reinforce the pattern. Every time you break them, you reinforce the pattern of breaking them. This is not metaphor. This is the actual mechanics of how behavioral habits form. And it means that the trader, who starts small and follows rules on small positions, building the neural pattern of consistent correct behavior, will perform better on larger positions than the trader who simply decides to start trading with discipline on a large account. The discipline on the large account will not appear from nowhere. It will only be there if it was built on the small one. The first practical application of this is what I think of as pre-commitment. Before the market opens, before you enter any position, you know exactly 3 things: why you are entering this specific trade, where you will exit if you are wrong, and what you will do if the market does not give you a clear signal either direction. You do not determine these things after you are inside a position with money at risk and your emotions already engaged. You determine them in cold blood, before the pressure exists. A decision made in cold blood is categorically different from a decision made in the heat of a moving market. The first is rational. The second is almost always compromised by emotion, in ways you will not even recognize in the moment. Pre-commitment removes the decision from the moment of maximum emotional interference. Your stop is not a choice you make when the price reaches it. It was set before you entered. Your exit target is not negotiated when you are sitting on a profit, and greed is whispering that there might be more. It was defined before the first dollar was at risk. When the market reaches those levels, you are not deciding. You are executing a decision that was already made by a calmer, more rational version of yourself. The second application is the trading journal, and I want to address the way most traders use this tool, which is to say, incorrectly. Most traders who keep journals record the technical details of their trades: entry price, exit price, profit or loss, maybe the pattern or indicator that triggered the entry. That information is useful but insufficient. What you actually need to record is your emotional state at the moment of entry, the reasoning you use to justify any deviation from your plan, and an honest assessment of whether you followed your rules or whether you made an exception, and what you told yourself to justify that exception. The patterns in this data are more valuable than any market analysis you could perform, because they show you exactly where and under what conditions your behavior breaks down. And once you can see those patterns clearly, you can begin to address them with specific countermeasures, rather than generic exhortations to be more disciplined. I knew a trader in the later years of my career who kept an extraordinary journal, not because his trade records were detailed, which they were, but because after every session, he would write a paragraph that began with the same question: what did I do today that my rules did not authorize? He was ruthlessly honest in these assessments. Over the course of a year, he identified 3 specific patterns in his own behavior that were responsible for the large majority of his losses. None of them were related to his analytical framework, which was sound. All 3 were behavioral. He was cutting winning trades too early when his journal showed him he was sitting on profits that felt safe enough. He was adding to losing positions after 2 separate painful losses, telling himself the move was temporary. And he was entering trades during the last hour of the session, when his energy and judgment were depleted, rationalizing them as opportunities he could not afford to miss. Once he saw these patterns clearly, he wrote 3 specific rules to address each one. Not general principles like exercise more patience or be more disciplined, specific behavioral rules with clear definitions of what they required. Within 6 months, his results transformed, not because his strategy changed, because he changed the behaviors that were undermining it. Risk control deserves its own treatment here, because it is the area where behavioral breakdown has the most catastrophic consequences. The purpose of position sizing is not only to manage financial exposure, it is to manage emotional exposure. A position that is too large relative to your capital does not just risk more money. It produces a level of emotional pressure that fundamentally alters your behavior. You check prices more frequently. You interpret ambiguous movements as threats. You exit too early when the position moves against you, and you hold on too long when you need to cut it, because the loss is too large to accept. Every professional trader knows this. Every professional trader has experienced it personally. And yet the temptation to size up, to take a position large enough to make a meaningful difference on a single trade, remains one of the most persistent and destructive impulses in the profession. The answer is a rule, not a feeling. You do not size your position based on how confident you feel about this particular trade. You size it based on a fixed percentage of your capital that you have decided in advance. In cold blood, is the maximum you will ever risk on a single idea. That rule does not change because you had a great morning. It does not change because this setup looks especially clean. It does not change, period. There is something else that undermines consistency that almost nobody addresses directly: the recovery trade. You have just taken a loss. The account is down. The instinct to recover it immediately, to take an aggressive trade that gets you back to even, is one of the most powerful and one of the most dangerous impulses in trading. I have seen more careers ended by recovery trades than by any other single behavioral pattern. Not by original bad decisions, which are inevitable, but by the escalating series of bad decisions that follows the first loss, when a trader cannot accept the loss as simply the cost of doing business, and begins trying to negotiate with the market to give it back. The market does not negotiate. The loss is real. The only response available to you is to take your next trade exactly as you would have taken it if the loss had never occurred, with the same sizing, the same rules, the same patience. That ability, to trade your next trade in cold blood after absorbing a painful loss, is the single clearest marker of professional-level consistency I have ever seen. Overtrading is the other side of the same coin. When the market is giving clear signals and your preparation is solid, acting is correct. But when you are in the market simply because you feel the need to be active, because you cannot stand watching the tape without having a position, because you have been right 3 times this week, and your confidence has reached a level that feels like certainty, these are precisely the moments when your risk is highest and your judgment is most compromised. The consistent trader has the same rule for overtrading that he has for undersizing his winners. A specific, defined limit on the number of positions he carries at one time and the number of new trades he will take in a given session. not a guideline, a rule. Because guidelines bend under pressure, and the market will always provide pressure. I want to leave you with something concrete that you can apply beginning today. Before your next trading session, write down 3 things. Your entry criteria, in specific terms that admit no ambiguity. Your maximum risk on the session, in dollars or percentage, after which you will stop trading regardless of what the market is doing, and your process for evaluating each trade after the session closes, specifically, whether you followed your rules or whether you made exceptions. These 3 commitments, made before the market opens and honored regardless of what happens inside it, are the beginning of the only path to consistency that actually exists. Not better analysis, not a superior strategy, not more knowledge, or a more sophisticated understanding of market structure. Consistent behavior, built through repeated correct action, honored most completely in the moments when it is hardest to honor. The market is neutral. It does not care about you. It does not know your name, your history, or your ambitions. It will reward correct behavior and punish incorrect behavior with exactly the same disinterest. What you bring to it, the only variable you actually control, is how you act, in the controlled moments and in the chaotic ones, in the winning streaks and in the losing runs, in the sessions when everything lines up and in the sessions when nothing does. The consistent trader is not the one who is always right. He is the one whose behavior is reliable, regardless of whether he is right or wrong on any given trade. That reliability, built slowly and honestly through repeated correct action, is the only foundation on which a trading career can actually stand. If this spoke to something real in your experience, drop a comment below and tell me which of these behavioral patterns you recognize most clearly in your own trading. Your honesty in that question is the beginning of the work that matters most.